Jobs Act. And one of the things that I did with Surish when we were talking about presenting here today was I said I'd like to give the group a quick overview of some things that they need to know for resources. So I emailed it, and I think they're going to make copies and make it available to you. The things that are in the resource section deal with the Jobs Act and changes. And the Jobs Act was a push by Congress to do something, in my opinion, because they didn't really like the crowdfunding idea. So they had to come up with some other exemptions and some other changes in the law, because the law's been pretty much the same for the last 40 years. So all of the verbiage that was on that quick video clip, if you were watching it and you were able to think about the words that appeared one at a time, the question in my mind is, did any of those words, well, first of all, let's just see, were anybody in the audience able to see the words shoot by one at a time? Yeah. Did any of the words mean anything to anybody in the audience? Sure. Because I think that's the premise, and what I've done is I've reduced that video now to these slides, and I'm going to go through them very quickly for you. The issuer is the entity that raises the capital, the company that wants money. If you're dealing with a crowdfunding situation, the platform is the crowdfunding mechanism where you are pushed out on the internet to the viewing audience that has an opportunity to see what it is that you're talking about. And I won't go into a lot of detail this time, and if you want to invite me back, I'll come back and go into detail on each and every one of these for you. But what they did in Congress was shift the burden to the Securities and Exchange Commission to come up with rules and regulations as to how to implement these Job Act changes. And they're pushing the platform to have to register. When they first passed the law, nobody knew how it was going to work. And it took months and months and months, and they kept putting it off, past the deadline, put it off, past the deadline, put it off, because they really didn't want it to take place, in my opinion. But it's taking place. And the platform has been burdened with the duty and responsibility to find out who it is that's coming on their platform and do some due diligence. And if you're either going to have the platform make its own regulations to find out who you are and what you have and what it's about, or a FINRA broker-dealer. FINRA is the Financial Regulatory Authority for the United States that regulates all of the banks and people that have securities license that can raise capital for you. The intermediary would be someone like myself that's an investment banker or broker-dealer that has securities licenses and can go out and sell a note, a debt, your stock, whatever it may be. Part of the premise of what's happened since the Job Act was passed and the rules started to become promulgated was there has been a push to say people have to be educated. The responsibility is somewhat spread amongst the issuer, and that for purposes of today, that would be the people in this room that are the entrepreneurial people hoping to raise some capital, or the broker-dealer firm that would be responsible to participate with the issuer, or the platform, because you are not going to use an independent broker-dealer, you're going to use the platform itself. All of that education has been spread around. So one of the things you have to start thinking about when you're putting an offering together is not only how are you going to tell your story to make people drawn to you and want to give you money because they love your idea and they love you, but how are you going to educate them in a way that it's understandable? I've read articles, people use different analogies. They say, you know, it's got the grandmother test, it's got the the simple English test. What does that mean? Well, all of those analogies mean the grandmother test, for instance, is if your grandmother doesn't understand it when you're telling it, it's too complicated. So you have to get it simple and in plain English. So think about two different prongs of your whole capital raising process. One is the story that makes you who you are and interesting and an attraction for money and investors. And the other is educating people about what you're doing and how you're doing it. Investor protection. The regulatory people have made it perfectly clear to all of the participants, the platform people, the broker-dealer people, the issuer people, and you won't, if you don't know it now, you will when you get into the process, that investor protection is everything. So you might as well start planning ahead on any kind of offering that you put together to determine how are you protecting the people that are going to give you money. That gets into another issue, which is risk. But how many people in this audience watch shows on TV like Shark Tank? You know, the first time I saw it, and I liked the show a lot. First time I saw it, I decided I was going to record the whole series and just watch them to see what I thought. Two things that come in to play from the very first show and most of the shows since then is the people step up, they're looking at the sharks, and they do their presentation, they try to make it cute, they try to make it rhyme or be somewhat cool, depending on what their product or service is. And as soon as they're finished, you have to ask the question, either A, they have given no information about valuation, and B, they didn't even act like they cared how they're going to get the money back. That's like, give me the money, I want to do cupcakes, give me the money, I want to make a surfboard. So the investor protection angle, if you analogize it to that show, is more like when you step up, put front and center and important, you want people's money, how are you going to protect it, and how are you going to get it back to them? What kind of return are you going to get? And you have to see what's the competition. And I don't mean the competition in, if you're a manufacturer, other manufacturers, if you're an IT or software, other IT or software. When I say competition, I mean that if you're going to launch your offering on February the 15th, 2014, and you go on a platform, there will probably be 15, 20, 30 other people on that platform. If you go to a conference like Judy has with FSX, we'll have at least 30 companies presenting, all different types of industry sectors. Well, what's the real question and issue that you need the answer to about competition? The competition there is, what is their offer or return? Some people are saying, well, we expect you to get 8% on your money. We expect you to get 6% on your money. We expect you to get an oil and gas deal return in 18 months, and someone else stands up and says, we think you'll get your capital back in 5 years. Well, that's your competition. Number one, from the broker-dealers that are there, because they're going to say, it's going to be a lot easier for me to sell an opportunity that has substance to it, that's going to get a return of capital realistically in 18 months than a return of capital in 5 years. If there's a fee to be paid to people to help you raise the money, and you're offering 5%, and you're offering 10%, the registered representatives, the registered investment advisors, the financial communities going to want to look at your deal first because they're going to make twice as much money. So you have to think about these components, and you have to think about what everybody else is offering at the same time. So if 30 deals go into a firm, 30 deals go into a platform, and they're looking at them all and people are screening them, that's your competition as regards raising capital, in addition to the competitive environment and competition in your specific industry sector. So those are things that are critical in doing a preparation here. Structure. The structure goes in the return of capital as well, but it also goes in, are you going to do debt? Or are you going to do equity? Or are you going to do a convertible of some kind, a convertible preferred, meaning you're taking the money in, you're putting it into a preferred share that can be converted into a common stock. There's all sorts. The limitations on structure are only limited by your imagination and the imagination of the advisors that you have. I have people all the time that reach a roadblock on, they're talking to people about investing in their company, and the only thing they're talking to them about is, I want $5 a share. I want $2 a share. And they don't want to give you $2 a share. That's not interesting for them. And they pick up the phone and call me and say, they like the company, they want to put money in it, well, we can't figure it out. Can you help us? That's your structure. And you really have to figure it out creatively because, again, that competitive environment, you want to set yourself apart and try to have something that is different and looks like you care, and front and foremost, you're interested in getting the investor people their money back. Valuation. Back to the Shark Tank. I think that one problem with entrepreneurs is blood, sweat, and tears. They've spent years thinking about it. Some people form companies. I had one not too long ago. They've been in, I said, how long have you been in business? 8 years. We have toiled, sweat, blood, 8 years to get to this point. And then you go on with the conversation and the story and you find out that for 6 of those years, they did 2 different things, both failed, and now they finally got an idea that they think is going to work, and they're just now getting ready to roll it out. And I said, you can't compensate yourself and make the investors pay because you had bad judgment and had 2 bad concepts that you didn't work. That's your investment capital-wise into the enterprise because now you have something worth having. So in evaluation, you have to be realistic. Sometimes it's a tough pill to swallow because, again, you've got to be a valuation model against people in your industry, but also the other competitors that are out there and how they're valued with the offer, the proposition, versus what your proposition is. So I think that you have to get realistic on, are you making revenue? About the only companies these days that can actually have some significant value pre-revenue are the IT companies. You know, we're back, I don't know if you read the article today in the New York Times. Did anybody see that? They're talking, no, it's USA Today. USA Today had an article that's talking about Google and Facebook, and they were showing, you know, like 14% increase. Facebook finally is showing revenue, finally showing an increase in revenue. I think Google stock was 1,100, something like that. You know, they're talking about all that. They're saying, okay, are we in another bubble? Are we back to 2000? And the argument in the article was, no, we're not, because they have revenue. They're a real company, and their revenue is escalating. Put those aside, you have to be realistic on, are you generating revenue, and do you make any profit, and what substance do you have in having a real definition of the marketplace, and how realistic it's going to be that the slice of the market you think you're going to get in a realistic time frame like 6, 12, 18, and 24 months is believable and somewhat provable as possible to happen based on your roadmap. Transparency today is everything. Lay it all out. You're not going to be able to hide behind smoke and mirrors. A lot of people did it. A lot of people got away with it. But the minute that you're caught at not being transparent and truthful today, you might as well have a ship and just drill a hole in it and sink, because you're going to be dead. Your credibility will be shot. All this Bernie Madoff stuff and Sir Ellen Sanford from Texas and all the Ponzi scheme issues, Unfortunately, for people that want to do non-transparent deals, those guys stole your stage and your thunder, and there's no longer an opening for that act. So you have to plan for telling people what other ventures you're in, the truth about the finances of the company, the truth about what people paid for their shares. Everything just has to be hung out like laundry on a line for everyone to be able to see, or you have to decide to raise your capital another way. Disclosure is pretty much the same thing. You have to disclose everything. Now here's one for the crooks. Believe it or not, if you tell people, if you invest in my company, my buddy and I are going to the Bahamas, and we're going to have a hell of a party, and I'm buying a Ferrari, and they give you the money, that's not too much they can do, because you disclosed exactly what your plans were. The problem is when people say, I'm going to have a use of proceeds that are going to do this, A, and then they take it and B, take off to South America. So telling the truth about what you're going to do with the money, believe it or not, people will give you some latitude about use of proceeds and what your intentions are and how you use the money. But you really have to be careful. I can tell you that we had a very successful offering, raised $20 million for a company. The PowerPoint throughout the whole roadshow showed that they had intended to increase their brand, do their marketing, labeling, and things for their product. After they got the money, they decided that vertical integration might be better, and they wanted to get into the manufacturing of their product, which was not disclosed. Everybody got upset. The people that were backing them got upset. They said they would settle down. They blew through a lot of money trying to change that model around. They came back and wanted more money. We gave them another $10 million, and this time they got it right and decided that they would stay with the program. The company has grown and is now, a New York Stock Exchange company. So you really have to be careful about what you're disclosing and on the use of proceeds. Be as realistic as you can about what you're going to do with the money. Why do you need the money? Why do you need that much? A big problem. I'll give you an example. We're here in Texas. I had a company that hired me. I flew down. I went to visit them. They told me they had to have $10 million. That was the number. Okay. We looked at their operation. We looked at their revenue. If my memory serves me right, because it's been several years, they did about $2 million in revenue. And if you multiply the share price that they had at the time, which was in the tank, it would have been, like a $5 million market cap. And I said, rather than argue with them about it, I knew that it made no sense whatsoever. I got a legal pad. And I took the legal pad, and I said, you know what? You're in luck. Because the industry sector that you're in, I happen to know a fund manager that's running 100 million plus, and I think they would listen to your message. So I'm pretty confident that I can talk to them. So let's just go ahead and assume, here's the checkbook. I want you guys to start writing on the pages what you're going to do with the money over a 6, 12-month, 18-month period of time. So we got to the 6-month check writing, we got to the 12-month check writing, and the two co-founders were having this big discussion. I'm sitting there, and they're having this discussion about this additional capital, and they were somewhere between $1.5 million and $2 million expended. And I said, okay, they stopped. Let's stop it right there. And I said, so I asked you how much you needed to implement the plan over the next 6, 12 months. You said $10 million. You can only spend $2 million. And I said, spend it on whatever you think is reasonable, like it's an open checkbook. And they said, we did. I said, well, then why do you need all this money? They said, because we may never get any more. I said, don't you realize how much you're diluting yourself? And I explained the issue of dilution because their valuation was so small at the time it was justifiable. By raising so much money because they thought they'd never get any more, didn't make any sense, and they couldn't even spend it prudently. So coming up with a realistic valuation, selling the appropriate amount of your company, whether it's 10%, 20%, 30%, at a good value for investors is investor protection. It's protection for you from dilution, and it's a legitimate function of the use of proceeds. Background, if you're in a situation where you've had problems in your past, you have to disclose them. There are certain rules as to time frames. I think like, bankruptcies, they report them generally for about 10 years. So there's a lot of issues. So you really have to decide whether the people that are running the company are in a position to disclose everything about their past, whether they've ever been arrested and convicted of a crime, whether they've ever had any problems with financial institutions, litigation that they've had in the past, bankruptcies, all of these things. Liquidity. Articles in the last 6 months have focused a lot on the SEC and FINRA about non-traded REITs. A REIT, for people that are not familiar, REIT is a real estate device, a real estate investment trust. And the problem with the real estate investment trust up until now is if you invested in a real estate investment trust before the new rules were passed, and each share, you invested your money, $10,000, $20,000, whatever the number is, it showed your share value at $10 per share. Next year, and every month you got a statement from your brokerage house, it said $10 a share. So you're thinking, I'm doing okay. I can count on that $25,000 or that $50,000 because it's reporting $10 a share. And year after year after year, people think they were doing okay. And what FINRA and the SEC have come in and done is say, you have to value this at current market value at least once a year. When they passed the rule and they took the top 10 REITs that were non-traded, most of them were showing $5.80, and people went through the roof. There was total shock and chaos of people that had these investments, and it's like, what happened? Why did we all of a sudden lose the value? You didn't. You lost that value 2, 3, 4 years ago. They just didn't tell you because they didn't have to. So in your situation for raising capital and liquidity, one of the things that the regulators are telling you today is be open and honest and give it your best analysis on a liquidity event. When is their share or their note or whatever you took in exchange for their money going to be able to be sold or traded? When can they exit? When can they have a liquidity event? When might you list on some public exchange? When might you cash out with the sale of your company? Whatever you're telling people your story is to get the money, valuation that's fair and reasonable, sustainable with proof, liquidity, how long their money is going to be tied up is critical in today's marketplace. Believe it or not, all these words were on that quick little video clip. Fees, how much you're paying people. You can't say, well, you and I were talking about 5%. We're gonna put that on the book. Looks real good. Everybody else is charging 10, but I'm gonna give you 5 under the table. So you're good. No, you're not. You have to disclose what fees are paid to who, no matter how they are adjusted in the front door, the back door, to a consulting agreement. Some people think, well, I can only get this much, but I really want that much, so we'll just do a side letter and a side deal for another consulting gig where I'm going to get some money. You can't do that anymore. That was prevalent for a long time. But trying to tighten up these rules is basically just saying, if you're a person that is honest with yourself and honest with the people that you're getting the money from, and you just sit down and tell them the truth about everything that's going on and what your plan is, you're okay. It's when you start trying to hide things that you're going to have a problem. The risks. I practiced law for a long time. I'm still qualified and I still get brought in on many, many cases that I do for raising capital, because unfortunately there are any lawyers in here? Good. So, you know, I have to deal with incompetent lawyers all the time. And I thought about sort of letting my brain shift and not worry about it so much, but I found the more capital I raised and the more deals I did, the sharper I had to be. I had to be ready so that on Friday, if I left and went on Monday into a law firm that was doing offering documents and securities work, that I could just pull up a chair and sit down and go to work. I had to be at par level with people. So I stayed that way, and it's paid off, because when I look at documents, I kind of grade them like a professor does. I don't have to sign off the liability insurance on the final document. But I think that the risk factors, what I like to do is put a big box in bold, and oftentimes I put it in red, and I will say, while we believe in ourselves and our management team and our investment, we don't think that we would be comfortable in you putting your money into this unless you felt you could lose the entire amount and not jeopardize you and your family, or something like that. Some people criticize me about that type of approach, but I'm like, you know, up front it makes people stop and think, gosh, I never thought about it from that perspective. But you really shouldn't be taking money from people that they just started a college fund, and now they're going to take the money that was going into the college fund for their kids and put it in your deal, and they lose it. They're going to hate you. You're going to have a poor relationship. It was probably not suitable for them. So unfortunately, in this climate and today with the changes, you have to think about taking people's money, and whether it's suitable, if you're in communication with them to understand that. And if not, the other people that are taking the money and giving it to you, that duty is passed on. So I think that if you want to be a stand-up, stellar entrepreneur, that you should think about taking people's money in situations where it's really not good. So I got to wrap it up. They just told me. So I'm going to do the rest of it really fast. Exit strategy. You can see my website to get some information. Next time we'll talk about visualization, because I can prove that it works. Talking about the clients and the lifestyle that you need to have, because I think balance is important. I think that we were going to have a little exercise, and maybe next time we will, because I have drilled what we do into 25 words or less, and it makes sense, and I think you need to do the same with me. I was going to go through an exercise about what capital raisers look for. Here's a list of 4 of them. Here's another 4. Here's another 6. Here's another 4. And I think that is the key element when you're raising capital. That's what people look for before they cut you a check. Thanks very much.
Questions?
Here's the...
Yeah, question for you.